Hello friends, let's understand the expectations theory or expectations approach that explains the differences between the spot prices and the futures prices of the contracts. In the earlier videos, I have explained you what are spot contracts, what are the examples of the spot contracts, and also I have taken the examples of futures contract. Now we have observed that there is a difference between the spot prices and the futures prices for different assets. I have explained this by taking the example of NIFTY 50 index and the NIFTY 50 futures. Now, what explains the differences between spot and futures prices? There are four broad approaches or theories that explain these differences. Number one, the expectations theory, which we are going to understand in more detail in this video. Number two, the normal backwardation theory. The number three is the cost of carry or cost of carry theory or approach. Number four is the integrated theory, which combines elements of all these three subsequent theories. Now, we will understand in this video in more detail what is an expectations theory and how it plays out in the market. We will understand expectations theory by looking at NIFTY 50 futures on National Stock Exchange, crude oil futures on Multi-Commodity Exchange, and Castor futures on National Commodities and Derivatives Exchange. On this screen, we see the NIFTY 50 futures available for trading in the National Stock Exchange on the 2nd of June 2023. Now we see that there are three futures contracts available for trading as of this time, which are expiring in the month of June, July and August on the last Thursday of each of the months. We find that there is a different price that is at which these contracts are being traded, and these prices are 18,583.40 for the contracts expiring in the month of June, 18,660 for the contracts expiring in the month of July, and 18,746.30 for the contracts expiring in the month of August 2023, which means that the market players are expecting the NIFTY 50 to be 18,583.40 in the month of June, around 29th of June, and then 18,746.30 in the month of August, around 31st of August, which is the last Thursday of August. Now we also see that the futures prices are less for the month of June, higher for the month of July and highest for the month of August, which means that the market expects that the NIFTY 50 will be rising over next 3 months. Whereas the underlying price, which is the NIFTY 50 index price, is same at this particular moment because the underlying asset for all these contracts is NIFTY 50 index, which is 18,501.60 right now. So we can see that for the same underlying asset, there is a difference in the prices for the contracts expiring in June, July and August, and the prices are more for the contracts expiring in the subsequent month. In the case of indexes and equity contracts, by and large, it is the cost of funds that are required to hold that particular asset till the date of expiry of the contract that explains the difference between the futures prices and the spot prices. We can see that the cost of carrying the asset for the month of June is relatively lower as compared to, let's say, buying the index and holding it till the month of July, and it will obviously be highest if you want to hold that index for till the month of August by physically buying those index contracts rather than buying the futures contract, which explains why the prices for the month of August are higher than the prices for the month of July, and prices for July are higher than the prices for the month of June. Also, these prices also reflect that the market overall expects to move up in the subsequent months. That is, there is a bullish trend in the market. So participants are expecting that in the next 3 months, the NIFTY will move higher. Now, there is not too much of a difference between the NIFTY index spot price and the NIFTY futures contracts, because even in case of futures contract, any expectations change in the prices of NIFTY 50 index will also reflect in the futures contract. If, let's say, the market turns bearish, in that case the NIFTY 50 index prices will go down, and so will the prices of futures contract, because these contracts are for very short term relatively, let's say 3 months. Now if the players expect the Nifty 50 to go down in the near future, that will reflect for the month of, let's say, July and August as well. So these prices very closely track each other, and since there is a daily settlement based on the last traded prices, which are calculated based on the last half an hour of volume on the National Stock Exchange, the daily settlement makes sure that you gain if you have long in the asset and the asset prices move up, and vice versa. Therefore, the contracts are getting settled on each day, and that settlement price is being reflected at your price at which your position is open on the next day. The cost of carry for these Nifty 50 indices futures very closely resembles the yield in the market for 91-day treasury bills, because most of these players have access to funds at almost the same rate as the government treasury bills yield in the market. Now let's go to multi-commodity exchange and look at the crude oil future contracts that are available for trading. Here, as we can see that the future contracts for crude oil are available for the months of June and July, expiring on 16th of June 2023 and 19th of July 2023 respectively. The price expected in the month of June as reflected in the futures contract is 5756, whereas the price expected in the month of July is 5785, which basically again shows the bullish trend in the price of crude oil based on this data. So July prices are higher than the prices for June contracts. And here on the MCX we can see that the recent spot price for the crude oil is 5747, which is lower than the futures price in the month of June and the month of July. So which basically reflects that there is a bullish trend, or the prices of the crude oil are expected to go up in the near future, and this expectation reflects in the prices of the futures contracts. As we can see, the futures prices are also closely tracking the spot prices, because if the spot price expectation goes up, obviously the futures price expectation will also go up and vice versa. So these prices very closely track each other for the contracts that are expiring in the near future, let's say next 3 months. Now let's go to NCDEX or National Commodities and Derivatives Exchange, and let's look at the spot prices and futures prices for the Castor seeds contracts. Here we can see from this screen that the prices expected in June 2023 for the Castor seed contracts are 5548 based on the last traded price, whereas these prices are higher in the month of July, which is 5632, and even higher in the month of August, which is 5719. Here if we go and look at the spot prices, obviously the underlying asset for all these contracts is the same, which is Castor seeds, and as for spot price for all these is same, which is 5633.80. If we go a little bit deeper and look at the spot prices, how they are moving, we can see that the spot prices at the end of the day close is 5674, whereas the spot price at the earlier time in the day was 5696.75, which was basically a higher price, which shows that there is an expectation that the spot prices might go down in the near future. The spot price trend shows us that the spot prices are expected to go down in the near future, which reflects in the prices of the futures contract. The spot price is 5633.80, which is lower than the price which was earlier in the day, which is 5674, and therefore the futures contracts are also being traded at a lower price, which is 5548 in the month of June, so which is even lower than the spot price as of now, which shows the expectation in the market that the Castor seeds prices will go down in the near future. Here on the screen we can also do a check by looking at the spot prices since last few days. As you can see, there is a downward trend in the spot prices of Castor seeds, which reflects the expectations of the market players about the spot prices for Castor seeds, and that expectation is built into the futures prices as well. So we looked at 3 different futures contracts to understand how the expectations determine the prices of futures contracts as compared to the spot contracts. We looked at Nifty 50 futures, we looked at crude oil futures. In both these cases, the futures prices were reflecting that there is expected to be an upward movement in the price of the underlying asset, which is Nifty 50 index as well as the crude oil prices. Whereas we can see that the futures prices for the month of expiry of June are lower for the Castor Shields contracts because there is a downward trend in the Castor Shields spot prices, and that reflects the overall sentiment of the market, where the participants are expecting that the Castor Shields prices will go down in the near future. So the market prices are fundamentally reflecting the expectations of different participants about the prices of the underlying asset in the future when these contracts are supposed to expire. The futures prices as well as the spot prices track each other very closely, because if there is too much of a divergence or difference between the futures prices and the spot prices, the arbitrageurs will enter into contracts in the spot market and then exploit the difference between the spot prices and the futures contracts. Therefore, as soon as the arbitrage begins, or the synchronization of prices of futures and the spot contracts in some time, and arbitrageurs make sure that these prices basically reflect the mood of the market in both the cases. I hope you have understood the expectations theory of the futures pricing in this video. If you found this video useful and interesting, please do share, as well as if you have any questions, please put them in the comment box. Thank you very much. Cheers.